Hi, welcome to our new quarterly video on credit. The fixed income and credit strategy teams will be sharing our views about the macroeconomic variables and earnings are affecting our view of the bond market and how we're investing in it. Thanks for joining us. I'm Alejandro Estevez-Breton, the Chief Fixed Income Strategist.
Hi, I'm Marcelo Menusso, the Chief Credit Strategist.
I'm Rafael Gaiao, Credit Strategist, and we represent Itaú Private Bank International.
Just to start off, I'm going to share very high-level ideas. First, corporate profits are facing a challenging environment given rising Fed rates and high wages. Inflation is slowing faster than wages, which may support disposable income for consumers, but raises two serious challenges. First, it threatens the Fed ability to contain inflation, and second, it may erode corporate earnings. Bottom line here is the risk is that persistently higher wages may lead to higher Fed rates and lower corporate profits. Just to change a little bit here, Rafael, what are the main highlights from the companies you've seen earnings report from, and what are you worried about?
For the companies that I follow, the earnings season has been better than feared. In emerging markets, most of the issuers increased leverage, but this was because of the price of commodities that were weaker than expected. In developed markets, the focus of the investors have been on the margins of the companies and how the company has been able to pass on costs. And again, the margins are better than the market was expecting. What I have seen in fixed income markets is that rates have been the main driver. The movement on treasuries explain most of the performance year to date so far. And the credit risk itself has been very little impact. Finally, I'm paying close attention to the primary market. Companies have been able to extend duration when yields were much lower than they are today, and they never come back to market. We have to monitor what the investors' reaction will be when the supply of new bonds come back to more normal levels. And you, Alejandro, how have you seen the earnings season so far?
Thank you, Rafael. So in general, the blue chip earnings season has been mixed. The earnings exceeded expectations with the number of companies and the magnitude of the surprises exceeding 10-year average. But the earnings recession was extended for a third consecutive quarter, with the second quarter shaping up to be potentially the largest decline since the third quarter of 2020. In terms of sectors, energy and materials are both facing annual declines in earnings and revenues, reflecting basically the broad decline in commodities in the second quarter of last year. In terms of consumer discretionary, which is a good bellwether of the consumer, in terms of services, it's very good, but in terms of goods and the manufacturing side is losing momentum. Looking forward, analysts are expecting earnings to rebound to zero, more or less flat in the third quarter, and about 7 to 8% in the fourth quarter. But generally, we have to be cautious because history indicates that to see a rebound in earnings, generally, or a GDP rebound, we need to see the Fed cutting rates substantially. So switching gears a little bit, Marcelo, how do you see the credit cycle playing out, and how do you think we should position our bond portfolio?
That's a great question, Alejandro. Right now, given that the environment is still challenging, with high interest rates and mixed earnings, we think the best is to be defensive and have a conservative approach. The asset class that we like the most in fixed income right now is investment grade, where you can find bonds with yields between 4 to 6%, which are actually very high yields for these companies, which were yielding anywhere between 1 to 3% just a few years ago. But that's not to say that we don't like high yield. On the contrary, we like high yield as well. But when we do high yield, we tend to focus on double B companies, which in other words are companies that have higher quality and are almost investment grade. Those companies could actually become investment grade down the road. And in this case, you can find yields anywhere between 6 to 8%, which we think is very attractive. Finally, a last consideration, which is very important, is duration. In other words, how long should the bonds be? Most of the bonds that we like, they are 10 years in maturity or less. So we're thinking a duration between 4 to 5 years on average. Again, that's not to say that there are no opportunities in longer bonds. There are, but then you have to be very selective when choosing the bonds. In sum, we think that the best right now is to focus on credit quality and to keep duration short. That combination should give you very solid returns over the long run.
Thanks very much, Marcelo. Thanks very much, Rafael. Thanks very much, everyone, for joining us today. If you have any questions, feel free to reach out to the banker or investor See you next quarter with a new edition of On Credit.